Hello and welcome to TechsRay, a TMT advisor podcast of CIMI Corporation. Today we're going to talk about Verizon and AT&T, and in particular their 4Q22 earnings report. What does this say about the two companies and about the future of the telcos overall? Let's start with Verizon. They had a slight beat in revenue and in earnings were in line for the fourth quarter. They had better than expected mobile ads. They had good business wireless growth and they had their best broadband fixed access ads in over a decade. Their earnings for 2023, the guidance missed significantly. 5G costs, which have had little or no impact on revenue growth, have actually impacted earnings quite a bit because they impacted costs. C-band spectrum costs in general have been their big problem, and they're expected to start falling in 2023. There was only a 1.2% year-to-year increase in business services, and Verizon said that most of this came from the SMB space. Verizon is catching up on T-Mobile with fixed wireless access, but it's still behind in that area. They had significant growth opportunities ahead into 5G era, so they say, but the problem is that they also admitted on the call that they had miscalculated on edge and on private 5G revenue growth. Verizon's arch rival AT&T has done better with Wall Street at least than Verizon has. Their earnings beat consensus estimates, but they were slightly below the analyst average. The revenue also met consensus revenues and estimates, and they were up slightly versus 2021's numbers. Wireless subscriber both beat significantly, and they beat Verizon's, but they lagged 2021 numbers. Fiber investment for residential and business sites was better, but they limited their investment guess to 30 million passes by the end of 2025, which is obviously a number that's significantly short of their total subscriber base. Fiber ads beat 2021 numbers, but they missed estimates. Business wireline revenues declined versus 2021. AT&T showed a very strong focus on their financial goals. They met their cost-cutting measures, they met their overall financial goals, and maybe most important of all for Wall Street, they supported their dividend via better than expected free cash flow. So all of this added up to the fact that the street generally took AT&T's report as positive, where they really took Verizon's report as negative. Let's look at the big questions that we have to answer with respect to these two companies to make any assessment about what's going to happen with them in the future and what might happen in the telecom space overall. The first question is, will the differences in demand density between AT&T and Verizon show in the way that they're addressing their futures? Demand density, you may recall, was roughly GDP for square mile of service area. And the higher your demand density, the more intrinsically profitable your home region would be. The second big question is, what are the companies saying about their capital spending plans? Are they looking to increase CapEx? Are they saying anything about how they might direct the CapEx? What's going on in the CapEx area? The third question is, how do the two plan to address the profit per bit challenges that they and all other operators have really had? And the final question is, do either of the companies have any plans for services beyond basic connectivity services, or at least plans that they've talked about? The first question, which is, how will the companies address the differences between demand density, or does either one of the two have any specific facts or measures that seem to relate to their demand density benefits or risks in the coming year? So starting with Verizon, their fiber deployment and FWA, fixed wireless access, are both well ahead of AT&T's. And I think that demonstrates the higher value of their demand density. Verizon has between 5 and 7 times the demand density of AT&T, depending on how you exactly measure the service areas. And so it's easier for them to profitably deploy either fiber or FWA because they have more opportunity per mile of past infrastructure. FWA might be the biggest weak spot for AT&T because both Verizon and T-Mobile are very aggressive with FWA, and FWA is really a good way of having low-cost, high-value broadband deployed in areas that are just not quite economical enough for fiber. AT&T, as you recall, has really got a kind of a minimal footprint of fiber targeted for their residential and business base, and they could have improved that a lot with FWA, but they don't seem committed to it at all. But AT&T seems much more active in wireless out of their home region. They're very aggressive in promoting their wireless services, and in particular, they're using the phone and phone promotions to target stuff in other regions. They're targeting Verizon's region, obviously, because Verizon's higher demand density means it's more profitable to operate there. The next of our big questions is what the companies are saying about their capital spending plans for 2023. Both companies are expecting CapEx growth to decline in 2023, and the fact that they make a point of saying that is a pretty good illustration of the fact that the companies are aware of the necessity of improving profit per bit, but they're really only dealing with it indirectly at this point by trying to reduce costs rather than raise revenues. Both companies are also attributing CapEx primarily to their 5G initiatives, and obviously both companies are disappointed that 5G has really not done all that well in terms of generating new revenue. Verizon, in fact, admits that they miscalculated 5G and edge computing, private 5G in particular, and AT&T, as I noted already, is really relying mostly on phone promotions to drive 5G growth. But all that that's really doing is substituting 5G for 4G LTE, and it's not changing the revenue return associated with the services for them much at all. Our next question is an important one, which is how do the two companies plan to address the profit per bit challenges that they have reported and that candidly all of the tier ones and probably all the operators in the world are reporting? The answer is nothing much, at least as far as what was said on their earnings reports. Neither company offered any specific comments on profit per bit, either saying that it was a problem or indicating that they had a particular way of planning on addressing it. Both companies are obviously committed mostly to cost management as their strategy for improving profit per bit, because both companies talked about CapEx reduction specifically as something that they were looking at. AT&T, maybe surprisingly, didn't make any comment about raising revenues through facilitating services, which is something they had introduced before. A facilitating service is a low-level wholesale offering that's intended to help OTTs offer better, higher-level services on top of connectivity. So in summary, we don't see any particular way that either company is planning on addressing any major changes in service or infrastructure direction to enhance profit per bit in 2023. And now our last question. Do any of the companies have any plans for services beyond the basic connectivity services? That's important because raising revenues would seem to be the most effective strategy for enhancing profit per bit. Cost management vanishes to a point. Every time you reduce costs, you lower the number of costs that you can reduce further, and so ultimately your strategy is going to run out of gas. But neither company really expressed any plans to provide any form of service beyond basic connectivity. Although Verizon did make a comment on edge computing that I've already related, which shows that they'd expected some enterprise opportunity to develop there. They also thought that they would make money on private 5G, which candidly was a stupid idea for them from the start. Both companies are the U.S. giants, and they're not expecting any change in strategy. That kind of is interesting given the fact that the European telcos have been looking for subsidies and been getting involved in joint ventures with each other for facilitating services. And in other words, taking measures that seem to be much broader and much more interesting. It's possible that what may be happening here is that the U.S. operators are waiting to see what the European Union does with regard to requiring big tech to subsidize the telcos. And if they decide to do that, obviously that would be a contribution to revenue that would reduce their profit per bit challenges. So if we look at a summary here, AT&T seems to be in the better place because while they're not talking about it on earnings calls, they seem to have a broader idea of what they're going to do to enhance their profit per bit story. And profit per bit is ultimately the metric that the operators have to look at. If your profit per bit is in trouble, then your company's heading in the wrong direction. AT&T has made changes to reduce their infrastructure costs. They've been aggressive, for example, in adopting the DriveNet's core router technology, the cluster routers, replacing the traditional router models from companies like Cisco. They've also been looking at this facilitating services concept, which frankly I'm disappointed that they didn't mention in the earnings calls. So where do we really see of telco overall as a consequence of all of this? And I think the answer is that telco is obviously still conservative. Their strategies for addressing their problems are just now starting to get out of the past and out of the we can hope for regulatory intervention strategy into something that's a little more sensible and which they can hope to adopt on their own without really expecting very much of anybody else. But nobody's here yet, not at the U.S. carriers nor any others. And so that seems to suggest that we're not going to see any broad changes in telco overall unless there are regulatory shifts like we're seeing potentially in Europe. And if there are no changes in how telcos do business overall, then I think we can expect to see an erosion in profit per bit and an erosion in telco financials. They're going to hit the ones that are taking no measures like Verizon perhaps harder than the rest. So thank you for listening, and this is TechsRay CIMI Corporation's podcast on technology, innovations, and changes.